Imagine a business model where your customers are literally growing while they use your product. They stay with you for 3, maybe 5 years. The demand is so high that people put their names on a waiting list before the customer is even born. And crucially, it's a service that allows the entire rest of the economy to function.
You make it sound like some high-tech subscription SaaS model, but you're talking about something much older, aren't you?
I am. We're talking about childcare, but not just babysitting. We're looking at the business of early education. Specifically, why 2026 seems to be the golden year for acquiring these centers. Particularly if you look at markets like Northeast Ohio. I was reading through some data on Geauga County in particular, and it feels like a hidden gem sector.
It absolutely is. And it's funny you mentioned the subscription model because financially speaking, that's exactly what a good childcare center is. It's recurring revenue with incredibly high retention. But to your point about 2026, this is a fascinating time. We've moved past the post-pandemic volatility. The return to office mandates have settled. Parents are working, and the reliance on family care has dipped. The professional childcare sector in places like Northeast Ohio isn't just stable. It's becoming essential infrastructure.
That's a strong term, infrastructure. Usually we think of roads and bridges.
Think about it though. If the childcare center closes, the parents can't go to work, the local hospital loses its nurses, the tech firms lose their developers. That's why when we look at business acquisitions, childcare is often termed recession resistant. Now, looking at the Northeast Ohio update you mentioned, the argument there is pretty compelling. It's about community integration. You aren't just buying a cash flow, you're buying a pillar of that community.
Right? And that brings me to the specific opportunities. Because there's a difference between starting one from scratch, dealing with zoning, licensing, hiring, and buying what they call a turnkey operation. I saw a listing for a legacy boutique childcare center in Geauga County. The word legacy caught my eye. That implies history, doesn't it?
Legacy is the magic word in this industry. In private equity or small business acquisition, a legacy center means the hard part is already done. The reputation is cemented. In a place like this, which, let's be honest, is an affluent market, reputation is everything. You can't buy trust with a marketing budget. You earn it over 20 years. If you're acquiring a center that's already known as the best in town, you have pricing power.
Let's dig into that affluent aspect. Geauga County isn't exactly a low cost area. Does that make the business riskier or does it insulate it?
It actually insulates it. In affluent markets, childcare is viewed as education, not just supervision. Parents aren't looking for the cheapest option, they are looking for the best curriculum and the best teacher to student ratios. That listing you saw, it's likely charging a premium. And the beautiful thing about the high end market is that it's less sensitive to economic downturns. If the economy wobbles, high net worth parents might cut back on luxury vacations, but they will rarely cut back on their child's development.
That makes sense. It's the last line item to go, but let's talk about the asset itself. One thing that stood out in these 2026 opportunities is the real estate component. A lot of these deals, not specifically this one in the Cleveland metro area, but many of them seem to include the property.
That is the game changer. If you are looking to buy a business, always ask, is the real estate included? With childcare, this can be a crucial consideration. If you own the building, you are paying rent to yourself. You're building equity in the physical asset while the business pays down the mortgage. Plus, childcare centers are often purpose built. They have specific zoning for playgrounds, safety requirements, fire codes. If you lease, you're at the mercy of a landlord who might not understand those nuances. Owning the dirt in a place like Geauga County, that's a retirement plan on top of a paycheck.
So you're essentially doubling down. You're a real estate investor and a business operator. But let's play devil's advocate for a second. I'm an investor. I know how to read a P&L statement, but I don't know the first thing about early childhood education. I don't know how to manage a room full of toddlers. Is this really a viable purchase for someone coming from a corporate background?
That is the number one fear I hear. I don't want to change diapers. And the answer is you shouldn't be. If you are buying a legacy center, you are buying a staffing structure. In Ohio specifically, the licensing requirements usually mandate a qualified director to be on site. Your role as the owner is strategy, marketing, payroll, and culture. You are the CEO, not the always the teacher.
So you're the manager.
Exactly. And frankly, bringing a corporate mindset to a local childcare center is often exactly what these businesses need to scale. Maybe they're still doing billing on paper. Maybe they don't have a digital app for parents to see photos of their kids during the day. A corporate refugee comes in, modernizes the back end, optimizes the cash flow, and suddenly that profit margin jumps dramatically.
That's a great point. Efficiency through modernization. I want to circle back to the 2026 timeline. Why now? The blog post for Transworld emphasized is now the time. What is it about the current economic cycle that makes this year different from, say, 2021 or 2030?
It's a convergence of three things. First, the baby boomer retirement wave is hitting small business owners hard. There are thousands of center owners who opened their doors in the 90s. They are ready to retire. They care deeply about their staff and the families. So they don't want to just close down. They want to sell to someone who cares. That means there's more inventory of high quality businesses than usual.
So it's a buyer's market in terms of availability?
Correct. Second, interest rates have stabilized compared to the shocks we saw a few years ago, making financing these acquisitions, especially with SBA loans, much more attractive. And third, the demand side. The wait lists in Northeast Ohio are real. When you have a business where demand exceeds supply, you have safety. You aren't spending your days cold calling for customers. Your customers are calling you, hoping a spot opens up.
That waitlist concept is fascinating. It's essentially a backlog of revenue, but surely there are risks. Like, it can't all be passive income and happy toddlers. What's the downside?
The downside is the human element. This is a people heavy business. You are managing staff who are often overworked and underpaid by industry standards. Though that's changing, staff turnover is your biggest headache. If you lose your lead teachers, the quality drops, the parents notice, and that legacy reputation takes a hit.
So the investment isn't just in the business, it's in the culture.
100%. If you buy that center in Geauga County, your first job isn't to raise prices, it's to sit down with the staff and make them feel secure. You have to retain the institutional knowledge. If you can keep the staff happy, the business runs itself. If the staff leaves, you have a very expensive lease.
It's interesting. We're talking about this as a financial transaction, but it feels much more emotional than buying a car wash or a laundromat.
It is. And that's actually part of the value proposition. When you own a childcare center, you become a central figure in hundreds of families' lives. You see these kids grow up. There is a pride of ownership that you just don't get with other asset classes. Plus, think about the impact. You are providing the environment where the next generation learns to socialize, to read, to share.
It's capitalism with a conscience.
Nicely put. And financially, let's look at the exit. Private equity is currently rolling up childcare centers. They are buying individual locations and forming large regional chains. So if you buy that center in Stark or Geauga now, run it for 7 years, modernize it, and max out that capacity, you aren't just selling to another individual later. You might be selling to a conglomerate for a significant multiple.
So the legacy boutique center eventually becomes part of a larger network. That's the life cycle.
It is. But for that window of time that you own it, it's a cash flowing asset that is largely immune to automation. AI isn't going to watch your 3-year-old. Robots aren't going to teach empathy. It is one of the few industries that is strictly beautifully human.
That's a profound thought. In an era where we are obsessed with AI and automation, the most valuable asset might be the one that requires the most human touch.
And the one that requires physical presence. You can't outsource childcare to another country. It has to be local. That's why the location, Stark, Geauga, these specific affluent or growing pockets matters so much. You are betting on that specific zip code.
Let's talk about the numbers loosely. Without getting into the exact balance sheet of the Geauga listing, generally, what do margins look like in this sector?
Typically, a well-run center aims for an EBITDA, earnings before interest, taxes, depreciation, and amortization, of anywhere from 15% to 25% of revenue. If you own the real estate, your cash flow looks even better because you aren't leaking money to rent. But the real metric is occupancy. A center at 60% occupancy is struggling. A center at 95% occupancy is a gold mine. The fixed costs, lights, insurance, director salary are the same whether you have 50 kids or 80 kids. Those last 30 kids are pure profit.
And that's why the waitlist is key. It ensures you're always operating at that pure profit capacity.
Exactly. And that's why buying an existing running business in 2026 is smarter than building. A new build starts at 0% occupancy and bleeds cash for 2 years. The Stark County and Cleveland Metro listings are likely already at that sweet spot. You're buying the cash flow on day one.
It really does sound like the sleeping giant of small business opportunities. It's not sexy like tech, it's not passive like a dividend stock, but the fundamentals are rock solid.
It's wealth building the old fashioned way, providing a necessary service to people who can afford to pay for it in a market with high barriers to entry. You can't just open a childcare center in your garage tomorrow. The regulations protect the incumbents.
So, for our listeners thinking about where to park their capital in 2026, if they see a listing for a childcare center in Ohio, don't scroll past it.
I'd say stop, look at the enrollment numbers, and make the call. It might be the best decision you make this decade.
It's a compelling case. We often look for the next big thing, but sometimes the best investment is the one that allows parents to go to work to build the next big thing. It's the foundation.
Well said. It's the infrastructure of the future, one toddler at a time.
We'll leave it there. A lot to think about regarding legacy, community, and the surprising economics of early education. Thanks for breaking it down.
Always a pleasure.